Gold is near historic highs. Mining stocks are still volatile. And investors keep asking the same question. If I want exposure to gold, do I buy the metal or do I buy the companies that dig it out of the ground? Because those are not the same thing, not even close. Let's break down gold stocks as physical bullion and ask, what job is gold supposed to do in your portfolio? That's the real question. So, if you buy physical gold, a coin, a bar, or a physically backed ETF, what are you actually buying? You're buying something that does effectively nothing. It doesn't produce income, it doesn't innovate, it just sits there. And it sounds boring, but that's the point. Gold is often used as a way to help protect purchasing power when confidence in financial systems start to wobble. Historically, gold has often performed well when inflation is elevated, real interest rates are low, the US dollar weakens, and/or there's geopolitical tension. In other words, when uncertainty rises, gold often benefits. I'm James Barrie, a senior investment advisor at the Cash Management Group. And if you'd like to discuss topics like this with me directly, make sure to click the Calendly link in the description below. So, where are we today? Gold is near elevated levels as we move through 2026. But why? Central banks continue to accumulate reserves. Debt levels across major economies remain elevated. Fiscal deficits are persistent. And global tensions are still very much present. That backdrop keeps gold relevant. And it's not just fundamentals talking. Canaccord analysts are weighing in too. A senior Canaccord Genuity advisor, Cam Curry, recently said that gold's momentum won't be slowing down anytime soon, and described gold as being on a new trajectory. He pointed to extremely high global debt as one of the forces making gold attractive as a safe haven. Canaccord analyst Reg Spencer has also remarked that there could be billions of dollars ready to flow into gold developers and explorers, reflecting a constructive view on gold equities as a levered way to benefit if gold prices continue higher. At a company level, Canaccord has nudged up the target prices on firms like Greatland Gold, reflecting a more positive near and medium-term outlook on some miners as commodity prices stay strong. Analysts' opinions reflect their views at a point in time and are not guarantees of future performance. But taken together, these viewpoints suggest that institutional research teams see continued relevance and possible structural strength in the gold complex, both for the metal itself and for the equities tied to it, as part of a broader macro trend. Now, let's talk about the other side, gold mining stocks. When you buy a Newmont, Barrick, Agnico Eagle, or even a broad-based ETF like GDX, you're not buying gold, you're buying a business with employees, fuel costs, equipment, debt. There is political exposure and management risk. And this is where the difference becomes critical. Mining stocks have something bullion does not: leverage. So if gold is about $5,060 per ounce, and it costs a miner about $1,300 to produce it, that leaves about $3,760 in margin. Now, imagine gold rises 10%. Gold goes roughly to $5,566. The company's margin doesn't rise 10%. It rises from $3,760 to $4,266. That's a 13% jump in profit. Same gold move, much bigger impact on earnings. That's the upside. But now flip it. If gold falls 10%, that margin compresses quickly. Mining stocks amplify gold's moves in both directions. That's why mining stocks are usually more volatile than bullion. They behave like equities because they are equities. Now zoom out. Gold producers today are in stronger financial shape than they were a decade ago. After a painful downturn from 2012 to 2015, many miners reduced debt and focused on free cash flow instead of chasing expansion. Today, margins are stronger than in prior downturn periods. Many large producers are generating solid cash flow at current gold prices. Some are paying dividend yields between roughly 2 and 4%. Gold bullion pays no yield. That's no small difference. If you're an income-focused investor, that matters. Mining stocks at times have traded at discounts compared to the gold price performance. That often reflects investor caution, operational risk, political risk, cost risk. So the sector is not priced like extreme optimism. That doesn't guarantee upside. It simply means expectations are not euphoric. Now let's talk about scenarios. Portfolio construction is really about the scenarios. Scenario 1, real interest rates fall. Inflation stays firm, geopolitical stress continues, and gold could continue to benefit. If gold rises 15%, bullion holders gain roughly 15%, minus small costs, for example, from about 5,060 to 5,828. Now, in scenario 2, real interest rates remain high, the US dollar strengthens, and inflation cools. Markets are stable, gold could decline. Bullion would likely move down in line with that decline. For example, a 10% move would be from about $5,060 to $4,554. Now, mining stocks in a strong upside scenario, profits expand faster than gold. During past gold bull markets, miners have outperformed the metal as earnings grew faster than the price itself. They may also provide dividend income during that period. But during stock market stress, mining stocks often fall with the broader market, even if gold is stable. And that's a key distinction. Bullion can act as a stabilizer. Mining stocks behave like cyclical equities. So how does this fit into a portfolio? Let's break it down into 2 examples. These are illustrative examples only, not personalized recommendations. A conservative investor. Their goal is stability, capital protection, and lower volatility. A possible structure might include 5 to 10% in physical gold or a gold-backed ETF. Minimal exposure to mining equities. A growth-oriented investor, on the other hand, their goal is higher long-term returns, comfortable with volatility, and they have a possible structure that might include 3 to 5% bullion as a base and 5 to 10% in mining stocks or ETFs like GDX. The potential mix of major producers and royalty companies. The bullion anchors the exposure, the mining stocks provide leverage. 2 different roles, but 1 coordinated strategy. And finally, and what would change the outlook if real interest rates stayed high for an extended period, if global growth accelerated with low inflation, if geopolitical tensions eased significantly, if the US dollar strengthened materially? Those conditions have historically produced demand for gold. Understanding those risks improves discipline. So, which one is better? It depends on the job. If you want stability and diversification, bullion may serve that purpose more cleanly. If you want upside, leverage to gold prices, and potential dividend income, well, mining equities offer more torque, but more volatility. Different tools, different risk profiles, different portfolio functions. If you'd like to evaluate how gold exposure, whether it be bullion, miners, or a blend of, fits into your portfolio specifically, you can book a meeting through the Calendly link in the description below. As a reminder, this content is for educational purposes only and does not constitute personal investment advice. Your individual circumstance may vary, and past performance does not guarantee future results. Strong portfolios aren't built on trends. They are built on structure.